On this episode of Real Estate Insiders Unfiltered, we talk about iBuying, institutional investors, rents going up or down, institutional investors coming in and out. It's going to be an incredible show. Tune in. You talk about it privately. We talk about it publicly. This is the Real Estate Insiders Unfiltered podcast. Welcome again to the Real Estate Insiders Unfiltered podcast. I'm your host, James Dwiggins, along with my co-host, Keith Robinson, aka Crazy Uncle. Keith.
Yes, sir.
Tell us who is coming on the show and what are we talking about?
Today we have Suresh Srinivasan from Roofstock. He's the chief marketing officer. He's going to be unpacking a bunch of stuff. Super smart.
Yeah.
He's going to talk about institutional investors, how they came into residential real estate and why, how some of the changes are impacting your mom and pop investors. He'll demystify for us this. Everyone's going to become an accidental investor because they've got a 3% interest rate and no one will ever sell their down leg property. He digs into that a bit. And he gave what so far is the best answer we have had to date to what superhero would you like to be? So put it in your ear, kids. Put it in your ear hole.
Let's get it started.
Let's go.
Suresh, welcome to the show. I know we are both very excited to have you here. Keith talks about lots of conversations he's had with you over the years. He has been giddy to get you on the show and talk about all of these fun questions we're going to ask you today. Let's start with just real quick. Who are you, your background, 1 minute or less, so that the listeners and viewers, don't get bored with biography. But tell them a little bit about your background, where your position is, and where you came from.
This feels very speed datey, like
just a little bit.
Just a little bit. Yeah, I love that. So I'll make it really quick.
Cool.
My career has been really at the. It's been all in tech. For the last 30 years, I've been in technology. 2 times as a co-founder of a company that I grew through eventual acquisition. So that was over the course of 15 years. The last 15 years have really been in real estate tech, building a couple of real estate marketplace businesses. Today, I'm at a company called Roofstock. It's a real estate investment platform focused purely on the single family rental space. And I've been at the company for 5 years and I'm chief marketing officer.
That's awesome.
Yeah.
Well, I know we're going to get into a lot of these discussions, and
I know we've got our rapid fire questions, but I'm going to ask one before we get to them because I love asking people who have come into real estate from outside. We've had several guests who have, and I ask this of everyone. What was the biggest?
Is it the gray hair from real estate or
no? Although he's got
probably coincided with that.
Sorry, Keith. Go ahead.
Is that correlative or causal? That's what you need to figure out. So, as someone who spent a decade and a half in tech outside of real estate before the last 5 years inside, what was the biggest surprise as you entered the residential real estate industry? What was the biggest thing where you're like, that's interesting, or I wasn't expecting that as you transitioned from sort of, I don't want to call it normal tech, but from a tech background to a real estate tech background?
Yeah, you know what? The biggest thing is figuring out how the industry works.
Yeah.
I mean, that was an eye opener. It's like,
have you figured it out yet?
Yeah.
No, I don't think so.
Okay. Yeah.
Write that book.
Yeah.
But it was surprising, right? You enter this and you're like, oh, okay, well, brokers and agents and everyone's like operating as a team and like hierarchical decision making and all that. Well, throw all that out the window. Right? You don't know.
Right.
And how do MLSs operate? You might think you know.
You don't know.
And then you realize, oh man, there's like 750 of these, and these are like cooperatives and don't necessarily operate.
And there might be some politics.
Yeah, maybe.
Perhaps.
Right?
Perhaps. Yeah. It's the level of complexity is. It's funny because we ask this of every guest, literally, who comes on who has come from outside, and that answer or something like it is the answer every time. And it's always interesting because after 25 years inside of it, right?
You sort of some advising of companies that are getting into the real estate space.
Yeah, and what besides don't
10% share of all those agents. Like, oh, good luck.
Every time, right? It always looks so good on the slide, on the cap raise slide. All right. Anyway, James, I don't want to steal your.
No, it's fine. I love it when these go off track because you're right. When they're like, oh, we're going to capture 80% of the industry and charge a license seat of this. And I'm like, and you're going to fail. So, I made fun of the gray hair. I have gray hair. Keith has no hair. So let's get back to the rapid fire. Just a little bit about you.
Can we stop talking about hair?
Quick questions, just real fast. Superhero, if you were to be one, who would it be and why? We want to hear the answer.
Yeah, superhero. I would say Plastic Man. You guys know Plastic Man?
Yeah.
No,
never heard of Plastic Man. Yeah,
the stretchy guy. He's like the Fantastic Four stretchy guy.
Yeah, he's the stretchy guy.
Yeah.
The reason I like Plastic Man, number one, is
that's a good one.
He takes the job seriously, but not himself so much. Like he was always a ham. and then second is like, man, he is resilient, right? He's like rubber. He like stretches and like. And so when you're a startup guy, you've got to be like Plastic Man.
Yeah, that's a good one.
That's a good one. Plus, you don't have to get out of bed to turn off the light. You just
exactly.
Right.
Convenient.
Yeah.
Right.
Yeah.
You know, I almost thought you were talking about me. I'm 6'7" and super skinny. People call me Gumby all the time. So, you know, there's that
stature there, but
but it's kind of funny. All right.
But if you were Plastic Man, you could be 6'7" if you wanted.
You could be whatever length you wanted to be.
That's
so, all right, favorite book or podcast?
Yeah, favorite book.
Other than this one,
read this pretty recently. Is a book called "Fall in Love with the Problem, Not the Solution."
Interesting.
This is Yuri Levine, the founder of Waze.
Yeah,
it's a great book. I don't know if you guys have read it. Very practical. It's almost like a guidebook for starting a company.
Number one takeaway from the book.
Yeah, number one is obsess over the problem. Most people have like a solution they've come up with in their mind, and they just keep trying to look for customers who want that. It's like obsess over the problem. Obsess over the problem, and then you'll find
the customers will show up if you really solve the problem.
Totally.
That's good.
Does the book have lots of pictures?
Yeah, it has a lot of pictures, but it's a really easy read.
I'm totally kidding.
So I'll be ordering the book, and James will be asking me what it's about. So
literally, do they have like the quick version of it? All right. So last one, which I always find to be the most interesting one. If you could have lunch with a current or historical, who?
Yeah, this probably changes weekly, man, based on my mood. But I think
who this week?
Yeah, this week is I think Leonardo da Vinci.
Ooh, that's a good one.
That's a good one.
I read that biography not too long ago. I don't know if you guys have read it, but I mean, this guy was amazing.
Amazing.
And not just an artist, right? Like painter, sculptor,
scientist,
engineer,
theorist.
I mean, this guy was coming up
philosopher
in tanks back in the 1400s.
Yeah.
Phenomenal. If you could have someone like that over for lunch, it's just, and
the questions you'd want to ask.
Yeah. In the modern world, like what would he be thinking of right now?
Yeah, that's a good answer. We got some good ones in there. Plastic Man's the first one we've heard on that. So
that's a solid pull. That's a good one. Pull.
All right, let's dive in. Let's get you into the expertise of why you're here. I'll start out. I know Keith has got a lot of questions to go through. So investors in general, I think the latest reports I've read is about a third of all real estate transactions were investors of some sort. Why? Like, where's this coming from? I have my thoughts, but where's your take on all of this?
Yeah, you know what? Historical averages have been anywhere between 15 and 20%. You know, when the market's like 5 or 6 million transactions a year, it's like, roughly a million or so.
Yeah.
Last year, what was happening is like, I think people call it like the denominator effect. When interest rates are hiking, both the owner occupant segment and the investor segment tend to slow down. But if the owner occupant segment is slowing down faster. Yeah. Then you've got, the share of transactions that are done by investors goes up. And so it looks like a big number, but we've seen it at Roofstock, right? Investors have slowed down as well.
But institutional, quote, air quote, institutional investors historically stayed away from holding real estate as a hard asset, right? They liked paper, they like investing in notes, and they're like, I don't really want to deal with broken toilets right? But that shifted at some point, and now institutional investors have, it seems like, I'm going to ask a question here at some point, but it seems like institutional investors have a comfort level with residential real estate as a hard asset, unlike they have ever had before. One, is that accurate? And then if that is accurate, why? What changed?
I think it's absolutely more comfortable today than it's ever been. I think you're right. In the past, the way they've had exposure, I mean, this asset class has always been a darling, but they've gotten into the asset class mostly on the debt side, right? Which is, mortgage-backed securities and whatnot. Direct ownership is really interesting in the sense that you could have, yield.
Right.
Your yield adjusts as rents rise.
Mm-hmm.
Then you've got home price appreciation as well. And so there's always been a large interest. I think the turning point was a great financial crisis. And
I agree with you.
when you had, home prices just falling, there was no retail backstop. Private equity jumped in and was buying homes galore.
Yeah, Invitation Homes and all of them were in there.
Eric
Yeah,
Beasley, our one of our co-founders of Roofstock, he was one of the guys who was, built up a massive team of folks buying homes at the courthouse steps, and he built a REIT to essentially prove that you could do this at scale.
Yeah, if your business is to create arbitrage, right?
Yeah.
Then, which is what private equity does, right?
Yep.
They want to create economies of scale and get arbitrage and buy when others are afraid.
Yeah,
I agree with you completely, because while they may have resisted it forever, 2008, either the world was over or real estate was going to come back. One of those two things. So for the first time ever, I think they really roll up their sleeves and are like, all right, I guess we have to figure out this whole toilets and, collecting rents thing. And then when they did, they found it out it's not as hard as they thought. And so now
I think there are a couple of conditions, right, that almost like forecast that an asset class is going to be institutionalized in real estate. One is just data and analytics. And in single family, it's so much harder than it is when you think about commercial, where there's been a ton of data around commercial for a long, long time. And you're essentially underwriting a single building that might have, let's say, 500 or 1,000 units inside, like a major apartment building, right? Here you've got 100 million homes.
Right.
And each one could be somewhat unique. And so you've got to aggregate a ton of data to figure out how to underwrite. And so I think, one aspect of it is just data. The second aspect of it is scaled property management. And that scares people away, right? It's like, all right, I'm going to go gobble up 5,000 homes, let's say, and I've got to somehow figure out how
manage
to across all these geographies. Like, that's really hard. And I think it was GFC happened. You had these early pioneers like Gary getting in the space, proving that you could do it at a certain level of scale. Venture VCs got into the space, right? Invested a lot of money in prop tech. And that helped a lot because it helped improve property management and scale and efficiency there. So you could almost, fast forward today, a decade or so later, and you're looking at efficiencies on the scale of the same efficiencies as managing like large multifamily.
Right.
Well, I have a question that is totally kind of off topic, but it's just, I think it's relevant. So I remember there's been lots of policies been proposed, I should say. San Francisco comes to mind, where, they were trying to do things to keep institutional investors out of buying properties so that they're not competing with, the family, mom and dad, single family people. So I guess my question is, do you think this is good to have institutional investors buying up all these properties, turning them into rentals, essentially doing it that way? Because the argument sort of makes sense. Like, you might be competing with a Wall Street firm for a house that you're trying to live in.
Well, and to add context to that, just for the listeners, the Wall Street firms are writing all cash offers, non-contingent. They're just coming in and buying the asset. Whereas the normal
has to finance it.
Has to finance it, has inspection contingency and the normal risk-adjusted offer price. So is it good? Is it bad? What do you think?
Look, I tend to think of these marketplaces as the more participants you have, the better. Now, look,
why?
Should certain regulations exist? I think it just makes for a more liquid market. You take that GFC example that I just gave, where there was no retail backstop. Private equity didn't jump in and help provide a backstop. Then
totally,
who knows where we would have been, right? And so you've got all this capital that can be in the market and help with liquidity. I think that's really important, and it helps owners who need to sell quickly and get out. The more capital that's in market, it's going to be more efficient for them. So that's one aspect of it.
Well, the true answer is it depends, right? So if you're already in the market, you love that institutional investors are consuming some percentage of available supply, because that puts upward pressure on your value or price, right? But if you're not in, it's bad, because I'll just say it, like, if you're writing an offer and you're competing against an institutional investor, you're going to lose. And that it's already hard for the first time home buyer to get their foot in the door, affordability is an issue. This is another thing that makes it even harder. So it sort of depends, James. I think if you're already in the market and your house is appreciating, well, it's going to appreciate a little faster because institutional investors are here. If you're trying to jam your foot in the door, well, the door is slamming a little harder now because there's another 800-pound gorilla pushing on the door.
Yeah. The other thing to think about is, where do you draw the limit? Where's the line? Like, what's an institution versus not?
Yeah.
And you've got small syndicates of individuals, could be the three of us who get together and decide we want to buy and invest in single family homes, let's say in Northern California or Southern California. Well, you're regulating them as you may also be regulating large institutional capital.
Yeah. Yeah.
The other thing that we've seen, and specifically here at Roofstock, and we've seen it in the data, is that when you have these large scaled operators, often what happens is that they're putting a lot more into rehab. Mm-hmm. One of the things that I know you guys are intimately familiar with is the housing stock is aging in the U.S.
Sure.
Generally, what's happening is they're going in, and we see the institutional capital. They don't want to deal with repair and maintenance and additional capex, onesie twosie here, throughout the year. So they put in $30,000 to $40,000 when they buy a home before leasing it out, and so that's like a nice counterbalance to what individual investors might do who have different appetites, different ways of managing the business. And so I think more participation is good.
Well,
do you think,
go ahead, James.
No, please go.
Well, I have a follow-up because I also think some of it is a moment in time, right? I hate when we pass laws or create restrictions for a moment in time because rates have gone up a lot in the last 18 months. That does change. Just a bit. I don't know if you were aware, James.
I just woke up.
Rates have gone up a lot. Well, that changes the 400 tab spreadsheets that these institutional investors are working from. The dynamics have changed, period, end of story, right? So how does that mean that they're going to start to throttle back a little because maybe the yield that you were mentioning before that they get, that's changed if a rate is gone from 8, 9 or 10% to from 3 or 4%? Or are they all cash and so it doesn't matter?
Well, they're all cash, but I mean everyone has a risk,
But they could place that money somewhere else and get a comparable return, right?
No, that's totally right. And I think one of the things you'll see happen is that the institutional participation is probably shifting from private equity, who's looking for a trade, or long-term, capital that just wants a durable, consistent
return. Yeah. An annuitized return versus a trade,
as opposed to private equity. And so I think that rotation, that shift is happening as well.
So I'm assuming with all of this, mom and pop investors are being priced out. They're struggling. I mean, obviously with interest rates where they are, the mom and pop flipper we're talking about, they're just going to struggle with this as more money comes into the market. Is that a fair assessment?
Well, as more money comes in the market, I think, the mom and pop, especially the fix and flip, they might be buying homes that generally are even outside the buy box for these institutions.
Okay.
Right. Require a lot more rehab. 30, 40K, for an institution is probably more in changing the flooring, upgrading the kitchen to something that's a little bit more modern. Fix and flipper could go in and entirely gut the thing and redo it and try to maximize, resale proceeds.
Yeah. But beyond the fix and flip, for the mom and pop investor, I guess, because that really, that's a lot of who you serve, right? That's, that's your constituents.
Right? There's probably two ends of the spectrum. One is the fix and flip. The other end is you got these rate sensitive investors who are thinking about more like portfolio allocation.
Right.
Mm-hmm.
And for those guys, once you're rate sensitive, those guys we have absolutely seen pause. Right.
They're out.
For them, it's like the risk-free rate is 5.1 or whatever. They could just rotate into securities or, high yield savings accounts and say, hey, let me enter
the same yield with zero risk, right? And no toilets. Right.
Exactly.
But so does that mean that was it harder for the mom and pop investor to add doors? And now it's gotten easier, or how has this institutional dollars now being comfortable with investing in residential real estate helped or harmed or made it harder? Harmed is a strong word. Made it harder for you're, the person that has maybe 6 doors in town that because they never sold the trade down, the down leg house. They never sold it. They just turned it into a rental. They did that 2 or 3 times and maybe picked up a duplex along the way. Have they gotten priced out, or are they still in the space? Because that's you serve them a lot, right?
Yeah, these buy boxes change so dramatically from one segment of the market to another. So institutions are generally buying higher priced homes. And so what we've seen with the mom and pop, they're a little bit more focused on current yield.
Yeah.
So they want a home that's like a 6 cap, whereas an institution's appetite might be, because their cost of capital could be a little bit different as well, right? So they might be willing to go down to like a 5 or a 4.5. And so when you have those differences in the market, and again, this market, like single family rentals, is like 10 million owners of 16 million homes. And only 3% of that is institutional. So it's largely mom and pop.
Dang, wait, say that again.
Say that stat again. I didn't know that. Yeah.
Unpack that stat.
Yeah. So 10 million owners of 16 million single family rental homes in the US. And that's like 4 trillion of asset value. And 3% is really institutions. So they're like a small, I know Wall Street loves to write about it and say, hey, here's the vultures.
I had no idea it was that small.
I didn't either, because we get, our industry has an echo chamber too, right? And so
we don't.
Yes, come on, just a little tiny one, just the Grand Canyon of echo chambers. But the narrative is always, there were 6 offers and my client got beat by all cash. It must be BlackRock, right? Or right, it's I'm competing against institutional investors.
Yeah,
but really that's not the case based off of what you just told us.
Yeah, maybe not. And you've got companies like Flight Homes, right, that have now are empowering an individual to make all cash offers as well. So there's been a lot of innovation, I would say. And
a lot of those companies aren't here anymore either.
Or not as aggressive.
Not as aggressive.
Yeah. Interesting. I'm going to ask you offline. I'm going to email you. I'd love to source those data points if you have them.
Totally.
Yeah.
Well, awesome. So I think this is it's actually a good lead into a couple questions. So is a lot of this due to supply side, dynamics of we're short 4.3 million units of housing in the country. So you've seen it obviously with even interest rates going up, housing prices haven't come down, or if they did, it was a negligible amount and it's all coming back, obviously. Is that driving a lot of this? Like, is that going to continue to drive institutional investors into the space? And if it, I guess my second question, I hate when people ask multiple, but my second part of that question, at least, if that changed, if we solved that supply side issue, would we see less institutional investors in the space?
Yeah. Put simply, how much is yield for institutional investors and how much is the appreciation rate? And if the appreciation rate went away, do they go away?
What Keith said.
Yeah. Look, I think the supply side, that you guys are mentioning definitely has a hand in it. If you've got supply shortage, you've got all this demand, you've got, home prices, of course, you can just, they're just going to continue to grow, right? And then you've got also like consumer habits have changed, right? And preference for more space. You've got the demographics, which is a tailwind in the space, which is like millennials have kids that are school age now. So they want to move to like better school districts and stuff. So there's a lot to like just about the asset class. I think that drives just investors at large, forget institution for a second. On the institutional side of it, I think, again, it's like not every institution's cut the same. So private equity is definitely out if you can't find an ARB, right? Right. We're done. And their IRRs are like, mid-teens to even think about it. Whereas like a pension fund is like, hey, if we can get an 8.5% return for the next 20 years,
we love it.
This still makes sense. And so I think that's what's going to happen. So I don't know. I mean, if there's some crazy avalanche of supply in the space,
there isn't any on the horizon right now.
We mentioned not by name, but we mentioned the iBuyer space before, the helping people make cash offer space.
I love talking about this.
Yeah, you do. Are iBuyers gone forever?
Yeah, I mean, look, if you look at what put them in business, right, is like the low cost of capital, and it allowed them to go and take a bunch of risk and try to get to national scale very quickly. Those models are, I mean, you see what happens, right? You're like trying to get a falling knife. It was like that black swan event that no one was like, all right.
Those of us who have been in the industry for a while and understand math and cyclical markets, we're like, this is going to come down crashing.
It's a problem waiting to happen, right?
When it does, and it will, it's going to be painful.
I think the problem is the exit door closed so quick, right?
Mm-hmm.
When rates double in 6 months and the market niche you're trying to create is built on a low cost of capital, you don't have time to pivot when it changes that quickly.
Really-
But to take the other side for just a sec, don't you think the human beings who sell homes, like if you were to sell your palatial estate that you live in,
speakeasy in the background,
which is great, by the way, wouldn't you be curious to know what you could get for all cash tonight, quick close?
I don't think these guys are gone. Look, there's some well-funded ones that they're just changing their models, right? So they're winding down the balance sheet, they're taking their hits, but they've got a lot of cash. And so you've seen folks like Open Door move to a little bit more of a marketplace model that's balance sheet light, still leveraging the strong brand, right? They went and promoted their brand, and so people know them now. And they've got still a ton of inbound lead flow. And so if you can, I think you said it right, which is, what they're providing is like certainty of closing.
Yeah.
Right. Which is a great innovation that came out of this.
Yeah.
I'll tell you, I've always thought the idea is interesting. And to Keith's point, I think a future, and I'm going to get, somebody's going to unsubscribe for this.
Yes.
I absolutely think a real estate agent should be armed with, on every listing appointment they take, with a cash offer opportunity.
Yeah.
How we structure that is the question.
Mm-hmm.
But to me, is if a company was the capital resource and we're partnering with brokerages, and there was some type of monetization still for the agent in that process, obviously not at the normal rate because it's just a cash offer and we leave and move on. But I think that's an interesting model. I think where they failed was they became the enemy of the realtor. And I think that was a really serious blunder on their part. And people don't, how many times have Keith, you and I said this, people underestimate the relationship between the consumer and their agent. They do it every single investment I've ever seen. You guys, I'm like, you're going to fail if you try to interfere with that relationship. But I think there's an interesting spot on how you work with the influencers to meet with that seller and go, here's this, and here's how we can do it fast. So
yeah, someone, and we're seeing them pivot that direction, right? We're seeing the iBuyers start to become
isn't it crazy? Like every tech company goes into it saying, hey, we're going to disrupt, take the middleman out or whatever. And it's like,
good luck.
Their model changes so quickly once they reach the realities of the market. It's like, you got to find a way to work with agents.
The famous American philosopher Mike Tyson once said, everyone has a plan until they get punched in the face. And those business models fall apart very quickly. Rents have been skyrocketing, going through the roof. When do you think, well, they have to retrench at some point or at least stabilize. Is that happening now? When do you see that? Like what's going, I know rents have gotten more expensive, but one, why? And then two, when do you see it slowing down, stopping, or retrenching?
Yeah, I think it's been slowing down. It depends on the market, of course.
Yep.
One of the reasons I think it is that, like we talked about before, like demographics and like people's preferences. Apartments are not real good substitutes for homes.
Right.
And so once you sort of grow out of your apartment, the single family home is kind of the next stop. And so you've got all this demand for housing, and like James, you were saying, 4.5 million, shortage.
4.3. Yeah. Mm-hmm.
I think that just drives, it's like a tailwind on rent growth, right? It's like you just got all this demand, and it's just going to keep pushing rents up. So, there's interesting things that states are doing now. It's like, all right, faster permitting on ADUs to try to create more affordable housing and stuff like that. I don't know that that's a substitute for a full home, but
it's maybe
more needs to be done to just create the supply.
There was actually I just noticed yesterday the Fed, the Housing Authority, I forget the name of the department, whatever, had a post on LinkedIn where they're actually holding a forum on how to help local governments work on zoning laws to start converting commercial space to housing. But to your point, people want a single family house, not an apartment.
Yeah.
Depending upon where they are in their life, obviously.
Yeah, we need more of both. But
yeah. Keith, you had mentioned to me about the accidental investor. I thought that was interesting.
So let's play real estate theory, shall we? So interest rates, historic lows, not today, but several years ago. So you have a whole swath of people who purchase properties at a very low interest rate. One of the things that gets thrown around, the old interwebs from time to time in conspiracy theory land is, well, there's a whole chunk of inventory that's gone forever. It'll never see the light of day again, because with people locked in at 3% or whatever their low rate is, they're going to become accidental investors, where instead of selling the down leg property to roll that equity into the up leg property, they're just going to hold it because it'll be a cash flow positive event for them. And they're just going to hold that asset and figure out how to save more money, or do a HELOC or do a cash out refinance, and then use those dollars
to do a down payment on the next.
down payment on the up leg. Do you think that is real? And then if so, is this one of those where we think it's massive, but it's like the institutional investors where it's only 3%?
Yeah. Look, I think it's attractive. If I put myself in the shoes of one of those people, it sounds great on the surface. And I don't know about a massive surge. I don't know. I'm skeptical. I think people will, like we've seen at Roofstock, for example, individual investors, we just see that there's so much pent up demand for people who want to get into investing. The moment they learn about it and they talk to, property management, and property manager tells you, oh, here are all the decisions you're going to be making throughout the life cycle of ownership. A lot of those folks are like, all right, it's not.
I'm good.
Right?
Yeah.
And so it sounds great. The 3% rate is super attractive. If you can find a high quality tenant to move in, it's great. But I think a lot of people, once they start digging in, they're like, all right, let me just sell it and move on. Or they might, sell it, go buy a second home that's a vacation home instead of being a long-term rental. So I don't know. I'm not on I don't think we're going to see a huge spike in that. There have actually been companies that went straight after that market, and those companies are now out of business to try to property
stay out of that, basically. Yeah.
Everybody wants to be a landlord until it's time to do some landlord shit, right? Like go collect rent or fix a broken toilet or whatever. Yeah, I agree with you.
Before we wrap up on the show here, I wanted to ask you, since you're looking at a lot of data, where do you think we are from a housing market, end of the year and then in 2024? Just your overall take on where you think things will be, inventory, interest rates, et cetera. So that's a good one. One of the interesting things that we were just talking about this morning here at Roofstock is the bid ask spread has been narrowing all year. Now, of course, we're looking at it through the lens of investors, but trades are actually starting to happen now. Whereas, 6 months ago, things were largely on pause. Supply is going to be an issue, of course. But, there's always this period, right, when there's a massive dislocation in the market. Sellers and buyers have to rationalize, like, hey, where are we going to meet in the middle? So it feels like it's kind of happening now. I think next year, look, all right, the Fed, I don't know if they're going to raise rates twice, before now and end of year. And certainly at least once. I think everybody's on that page.
I think so. But I think, I don't know, things are looking good. I think second half of next year and beyond, I think things are going to start feeling a little bit more like a return to normal. We already saw with the inflation CPI prints, that things are starting to slow down a little bit. And so I think we're getting back into normal territory. And so
we saw one. We need two. We need two to have a trend line.
Yeah, that's why I'm not predicting anything right now.
Yeah. Fair.
All right, Keith, take us to the finish line. You have your final question you always like to ask.
This is my favorite final question. So, if you were a real estate agent, what is the one thing that you would do, change, add to your business,
implement,
to make a massive difference today or tomorrow? What if you were a real estate professional, what would you change in your business or add to it?
Yeah, you know what? I mean, this is probably partly the entrepreneur in me, but I think agents are like this as well. Is go on the offensive. I think these are times where don't sit back, don't take it easy. If you are a solo agent going at it on your own, how about form a team? You've got new agents who have entered who probably don't have a reputation, don't really have much activity. Like, get them on your side. They could go do the door knocking and all that kind of stuff and help you expand your name. You could, maybe do things like, I know supply is scarce, but people still have to list their homes and sell.
Totally. Just got to find them.
You got to go find them. And so how about set a goal and say, hey, I want, my lawn sign to be in front of a third of the listings in this market, and figure out a way to go get it. I don't think it's going to be that hard. And then second is, I would say offensive, think about like adjacent categories like the investor market, like educate yourself and say, all right, we just rattle off the stats, right, of how many owners of rental properties they are. And this is a growing market. Well, leasing is is sorely needed and pays, right? When you find a qualified tenant for a landlord, they're going to pay you 50 or 100% of that first month's rent. So if you build this team, maybe that's the way the team is fed while they're helping you expand your brand awareness, and it gives you some room to think about how to grow your business.
I love it.
Yeah, I love it too. I think scared money doesn't make money, right? This is a time where if you can lean in and go for it, you can get your unfair share on the other side. So I totally agree. I think a mindset approach is critical right now. Totally. It's a great answer.
Yeah. Well, Suresh.
Yeah.
Well, thank you for being on the show. That was awesome. I learned a lot. Keith we've had a couple of guests on our pod recently that falls into the economic category where I am learning a lot and Keith is acting like a nerd, kind of like how I'm about weather, which you made fun of the other day.
We've definitely had a run of my guests lately.
Yes.
Economists and investor centric businesses are my favorite.
It was awesome.
Yeah, I appreciate it. Thank you guys.
We appreciate it. We'll definitely want to have you back. So
thanks.
You don't want to let Keith down, do you? Hit subscribe, and not only will you never miss an episode of this podcast, but you'll also never make Keith sad. He's easily entertained.